This is the only video you ever need on candlestick, and I promise you are going to get the value of why we're here. So the best thing you can do is to make sure you get a pen and a jotter where you're able to learn and put down all these things I'm about to tell you. So what are candlesticks? Candlesticks are just the information given by the market at a particular point in time, and a candlestick has four major points, which is the high, the low, the open and the close. Every candlestick has these four things in common. The only difference is their size and the color, right? The size and their color is what the only difference. So in this video I'm going to show you how all these candlestick rates, why candlestick push the price, why the candlestick shows the information the candlestick is passing to us, and how you can actually use that as in your trading decision. So coming up as a technical analyst, I always find it hard to actually trade technical analysis, to actually trade using technical analysis, because this candlestick can be too much of an hassle, and at times the names of this candlestick are just too many. They are just so many. In this video I'm going to give you different types of candlestick and how you can actually apply them in real trading. Knowledge without application is just a waste of time, right? So in this video I'm going to show you all the candlesticks that are listed there, such as the engulfing pattern candlestick, the hammer, the shooting star, the evening star, the morning star, the bullish and bearish aramis. We have the three white soldier, the doji, everything will be taught today. So make sure you follow me and subscribe to this channel in case you've not done that. That is the only way you can reward us for this work. Trust me, we appreciate you a lot, and we also like you to follow us for more videos like this. Without further ado, let's get started on the chart. So let's start with the hammer. The hammer is a candlestick that shows the rejection of lower prices. And when we're talking about the hammer is a candle that shows reversal. That means the market is already coming down. Whenever there is a hammer, the market is more likely to go in the other direction. Please note that this does not happen all of the time, but most of the time. And candlesticks are not meant to be traded alone in isolation. That's where you need your support and resistance with the market structure. But you need to know how all this candlestick works. So like the name implies, hammer, just like the normal hammer that is used for house furnishing and other stuffs. Hammer has the same anatomy as the real hammer we are using. That means the wick is always very long. This is the wick. This is the wick. While the body it has the upper wick of just small upper wick with usually a longer lower wick. So this is hammer. As you can see this is hammer, as you can see here. So this is hammer, just highlighted it. So this is hammer here. You can see this candlestick, right? If I zoom in very well for you guys, you can see that on this hammer, the market was actually going down. But at this point in time, when the hammer forms, the market change its direction. So hammer means rejection of lower prices. That means which means that when this market first opened, the sellers were able to push the market downward, while the buyers stepped in and push the market upward. So hammer has two types of color. You can see the bearish and the bullish hammer. The anatomy is the same. However, hammers that shows green color are more better than the ones that show red colors. Now listen, you can see this is green color, right? It actually shows that market went up. Now this is another hammer, but this is actually red or bearish hammer. So in this bearish hammer, you can see that even though it formed, the market still eventually went on coming down. But like I said, if you want to use hammer in a very correct concept, make sure you use it with the support. So looking at this, we could easily see that there is support at this region. Because you see that there is support at this region. So when you see a support and the hammer is forming, it's an opportunity for you to go long. Now see another hammer at this region. See another hammer. It is the bearish form of hammer, but it is still hammer. And see what happened when the market formed. The hammer was forming on the support. See what happened is the market actually goes up. Now you should know one thing about candlestick today. Candlestick are always odd and opposite. That means as we have hammer, we have the bearish part of it. We have the bearish or the opposite of hammer. So the opposite of hammer leads us to the second candlestick we'll be analyzing today, which is the shooting star. So the shooting star is also called the inverted hammer. Now, for the inverted hammer, it shows the rejection of higher prices, and whenever it forms, most likely the market will come down. For the normal hammer, if hammer forms on the market, most likely the market will go up. But for the inverted one, when it forms, most likely the market will eventually come down. That is the inverted, or another name for inverted hammer is shooting. Something here. You can see this one, right? This is shooting star. You can see how shooting star looks like. So this is shooting star here. This is another shooting star. This is another shooting star. Now, shooting star always have long upper wick and short lower wick, just the opposite of the normal hammer. Just the opposite. You can see that what happened when it forms, market start coming down. Again, if you want to use this hammer on a good concept, or this inverted hammer or the shooting star, use it where there is a resistance. You can see that there was a resistance at this region. And when it happened, the market eventually come down. Now, another one here is you can see there's another resistance here. This was the resistance that has been formed there. You can see that an hammer formed here. So bearish hammer that is red in color is actually bad. Hammer that is green in color is actually very good. Same thing, shooting star that is red in color is good. While shooting star that is green in color is not really advisable for you to trade it, even though they mean the same thing. So my conclusion is don't focus on the color, focus on the anatomy. For instance, here, focus on the anatomy and the concept at which you are using it. Now, see this region. If I'm drawing this, can see that there was an hammer here. Can see that there was an hammer here. Can see this hammer at this region. There was an hammer here, and see what happened to the market next. Markets came down when this hammer formed. So don't focus on the color, focus on the anatomy and the concept, the message it is passing. So, like I said, candlestick has 4 body colors. We have the open, we have the close, we have the highs, and we have the low. So for the shooting star, when the market first opened, the buyers were able to push the market upward. Then the sellers came in and drove the price downward. Very easy as possible. Now, another one is what we call the bullish engulfing candlestick. So bullish engulfing, like from the name engulf means to completely cover something. That means bullish engulfing requires 2 candlesticks, at least 2 candlesticks. It can be more than 2, but you cannot say a candlestick is engulfing if it is only one. Now, for instance, see this one here. See this one right here. You can see that this one that I just highlighted there, the green completely covers the bearish. The bullish, which is the green, completely covers the black, showing a what? A bullish engulfing candlestick. So for this bullish engulfing candlestick, when it engulfs it, you can see that the markets were able to push up. Now, what does it mean? Bullish engulfing means in the first session, when the market opened at a particular point in time, the sellers were able to push the price lower. Now, in the next session, the buyers step into the market and push the price upward. Very easy, very simple as that. So once you know this, you also want to make sure that you are not trading bullish engulfing in isolation. You want to trade it with other confluences, such as the market structure and other support and resistance. So the opposite of bearish engulfing leads us of bullish engulfing leads us to the 4th candlestick, which is the bearish engulfing. So the bearish engulfing is just the direct opposite of the bullish engulfing. What does it say? It says that, for instance, now this is bearish engulfing here. This is bearish engulfing here. So for the bearish engulfing, this shows that, okay, let me look for a bearish engulfing. Now, bearish engulfing must be obvious. If it's not obvious, then it's not bearish engulfing. So see something here. These 2 candlesticks that I just highlighted here, this is what we call bearish engulfing. You can see that in the first instance, it was the buyers that were around, showing us this green bullish candlestick. Then the seller stepped in and completely covers the buyers, which means that they push the market lower than where the buyers started buying. So let's say this is 12 o'clock. The buyers started buying the market in 12 o'clock at $2,000 per Ethereum price. Then the next 1 hour, let's assume you are using 1 hour charts. The next 1 hour, the market, the buyers came in, the sellers came in and pushed the price lower than that 2,100 dollars. And know this and know this. Each candlestick here, as you can see, each candlestick here, as you can see, represents the time frame that it forms. So that means I'm on a 4 hours time frame. Each candlestick here shows that it forms for 4 hours. If I'm on a 1 day time frame to show me a different type, each candlestick shows that it forms for a day. If I'm on a 1 hour time frame, it shows that each candlestick here forms for every 1 hour. So on these 4 hours, each candlestick represents the information that happened at every 4 hours. I hope this makes sense, right? Please let me know in the comment section if you understand everything I've been saying this morning. This is another example of bearish engulfing. You can see this bearish engulfing as it formed right here. You can see that when it formed, what happened to the market? The market plummeted. The market went down, right? You can see that the market went down like this. So when this happened, market went up a little and went down eventually. And also there's another bearish engulfing here. So bearish engulfing, for you to use bearish engulfing very well, you want to make sure that you want to make sure that it is used as the at the resistance level. The resistance level is very, very important. So this is another bearish engulfing. So we can see that the black, the sellers completely engulfs the buyers. So that's bearish engulfing. So another bearish engulfing candlestick. So what you want to do to actually after watching this video, make sure you go on your chart and identify it one by one. That's the best way you can actually help yourself. So when there's bearish engulfing, 85 or 90% of the time, the market will always come down, provided that the market, provided that it is forming on a resistance. So make sure that you are aware that the market must form at the resistance for you to actually take a trading decision on bearish engulfing. And see what happened here. The market pushed down when this bearish engulfing formed. Market pushed down. Again, here again, when this bearish engulfing formed, the market pushed down. So when you know these things, you are very good to go. So making the fourth candlestick, I'll be showing you guys. Now, there's another form of candlestick that most traders don't actually trade whenever it forms, and that is what we call doji candlestick. Now, doji means indecision. That means there is no winner and there is no loser. The buyers and the sellers are equal at that particular point in time, or should I say almost equal. So when you see a candlestick that has tiny body or tiny to no body and a wick, either the wick might be long or short, but what matters is that in the doji candlestick, the body is always very, very tiny. Now let me show you. So this is it. This is a doji candlestick. Let me show you for you guys very well. So this candlestick right here is doji candlestick. So this shows that forget the color about in doji. Focus on the anatomy. Consider that the body is very tiny and it forms at almost equal length, meaning that at this region, when the buyers came in, they pushed the price up. The sellers came in with equal pressure, showing that there's no winner and there's no loser. So whenever you see a doji price, a doji candlestick forming on the market, you want to make sure that you wait for the market to eventually form first before you eventually take a trading decision, either to go long or to go short. So this is another doji candlestick here. You can see that the body is very, very tiny. Let me show you guys. You can see the body is very, very tiny here. You can see this one, right? The body is very, very tiny. Now, when this forms, you want to make sure that you wait for the market to eventually do its thing before you make a trading decision. This is another doji. So don't forget that doji means indecision. Now, doji candlesticks are divided into two. We have the gravestone doji, or we have the dragonfly doji. You are going to see all these candlesticks in the picture in this video, right? So gravestone doji, showing you guys again to make it make sense. Gravestone doji forms like this. Gravestone doji forms like this. So they form like this. Why dragonfly doji? You know, grave is always on the ground, right? So why the dragonfly doji forms like, a dragonfly is an insect that always flies, right? So this is the gravestone at the left, while this is the dragonfly doji at the right. So the two of them is still saying the same thing, meaning that this market is still an indecision. So this is the two example of doji. This is what gravestone doji. You can see these two, right? They are very tiny, little to nobody, and you can see how this thing works, right? So let's look for the dragonfly doji. So this is another gravestone doji. In fact, this is another gravestone doji. You can see that the body is almost not forming, right? So when you see that one, you want to stay off the market. This is another gravestone doji. When doji forms on the market, you stay away from the market. So this is another gravestone doji. So you can see how this thing forms, right? So this is another gravestone. This is dragonfly doji. So showing that there is indecision in the market. So doji is still doji, just the names that differs based on the anatomy. But what matters is that they are for indecision, so you don't trade when you see them. Then the next set of candlestick I'll be teaching you is what we call the morning star candlestick. Morning star candlestick comprises of three kind of candles. Three kind of candles, right? The first one is usually bearish. The second one is more of indecision, while the last one is bullish. That is what made so bearish, indecision, bullish. Now let me show you guys. So on this point now, you can see a morning star candlestick. Now this is a morning star candlestick right here. So see this morning star candlestick right here. You can see this region, right? See this. I'm coming. Sorry. See this morning star candlestick. Now when you see this morning star candlestick, you can see that it comprises of three candlesticks. The bearish, the indecision, then the bullish. Now you can see what happened next in the market. The market went up. So morning star is a 3-man candle. It has to be 3. If it is 2, there is not complete. Consider now morning star should not be used in isolation, should not be used alone. Use it where the market is near support. The opposite of morning star is what we call the evening star. So evening star is also the bearish part of the morning star, the bearish opposite of the morning star. When it forms, you want to make sure that you do this thing in a very right way, and you want to make sure that it is not traded in isolation. It is traded with support. These two candlesticks is traded with support or resistance. So let's look for. So this is a morning star candlestick. This is an evening star candlestick. You can see now the first one should be bearish. The first one will be bullish. Second one will be most likely indecision, while the third one is bearish. And you can see what happens in the market next. The market plummeted. So making 8 forms of candlestick that you've been taught. Morning and we have the hammer and the shooting star. We have the bullish engulfing and bearish engulfing, the 2 type of doji. Then we have the morning star and the evening star. So when you know this basic form of candlesticks, you have a very good edge. Now the next one I'll be teaching is the 3 soldiers. 3 soldiers is just 3 consecutive candlestick, 3 consecutive bullish candlestick or green candlestick that follow each other. So you can see this 1, 2, 3. 1, 2, 3 here. You can see this region, right? So this is the morning. This is the 3 soldiers. When it forms, it shows that the market will continue going up. In 80% of the time, whenever it forms, the market continue going up. See this one. This is another evening star. This is another 3 soldiers. 1, 2, 3. You can see it. You can see that the market continue going up, right? This is another one. 1, 2, 3. You can see how the market continuing going up. So when you know all these things, now the opposite is the 3 red candlestick. You can see this 3. 1, 2, 3. When it forms, markets went up a little and eventually came down. So when you know all these candlesticks, you want to make sure that they are not traded in isolation. If you are trading them alone, you are setting yourself up for a loss. And don't forget to subscribe to this channel if you're enjoying this video. Subscribe. That's the video you can use in paying us back. Please and please subscribe to this channel. And so the final remark. These are the things that you must check. Number 1 is the body to the wick. If the body is long, longer than the wick, that means it is a strong buying or selling pressure. So this candlestick, as you are seeing here, shows that it is strong. The selling pressure here is strong, stronger than the selling pressure that happened there. Second thing you want to check it if they are forming at a support and resistance before you can take a trading decision on it. And the last thing you want to do is that You don't trade them in isolation. So make sure to subscribe to this channel, and thank you so much for watching this video to the end. Let me know the topic you would love to learn in the comment section. I'll be waiting. Thank you and see you there.